Imagine spending 20 years building your retirement fund. Every month, you save money. Every year, you trust your company a little more. Then one morning, you check your account and discover that most of your savings have disappeared. Not because of a war, not because of a recession, not because of a market crash, but because one of the most respected companies in America was hiding a lie. A lie so large that it would eventually destroy billions of dollars and shock the entire world. That company was Enron. In 2001, Enron was considered one of the smartest businesses on earth. Fortune magazine had named it America's most innovative company for 6 consecutive years. Investors loved it. Analysts praised it. Politicians respected it. Business schools studied it. At its peak, Enron reported more than $100 billion in annual revenue and was valued at over $60 billion. To millions of people, it looked unstoppable. But behind the scenes, something was terribly wrong. The strange part is that Enron wasn't selling fake products. It wasn't running a secret criminal organization. It operated real businesses, signed real contracts, and employed thousands of people. Yet years later, investigators would uncover hidden debt, misleading financial statements, secret partnerships, and accounting tricks so complex that even professionals struggled to understand them. The company looked healthy from the outside. Inside, it was slowly falling apart. What makes this story fascinating is that the warning signs existed long before the collapse. Some employees noticed unusual transactions. Some analysts couldn't understand Enron's financial reports. Journalists started asking uncomfortable questions. One executive even warned that the company could collapse in a wave of accounting scandals. But almost nobody listened. Why? Because Enron wasn't just selling energy anymore. It was selling a dream. And people desperately wanted to believe it. Years later, investigators would discover that some of the company's biggest profits weren't as real as investors believed. Some debts had been hidden. Some losses had been moved out of sight. Some deals existed mainly to improve appearances. The deeper investigators looked, the more shocking the picture became. But here's the question. If the warning signs were there, why didn't anyone stop it before everything collapsed? The answer involves 3 powerful men. Kenneth Lay, the founder who built Enron's reputation. Jeffrey Skilling, the executive often described as a business genius. And Andrew Fastow, the financial architect who created some of the most controversial structures in corporate history. Together, they transformed Enron from a traditional energy company into a Wall Street superstar. They also created a system that would eventually become impossible to control. When the collapse finally came, the damage was enormous. Thousands of employees lost jobs. Investors lost billions of dollars. Retirement accounts were devastated. One of the world's largest accounting firms collapsed. Federal investigations followed. Criminal trials followed. And Enron became a symbol of what can happen when growth becomes more important than truth. But before Enron became one of the biggest business scandals ever recorded, it was simply a company with an ambitious vision and a charismatic leader. Nobody knew that one day it would become a warning taught in business schools around the world. And the story of how that happened begins in Texas, with a man who believed he could build an energy empire. The story of Enron begins in 1985, when Kenneth Lay merged 2 natural gas pipeline companies to create a new business called Enron. At first, there was nothing unusual about it. The company transported natural gas through pipelines across America. It was stable, predictable, and honestly, a little boring. Nobody could have imagined that this ordinary energy company would one day become the center of one of the biggest corporate scandals in history. Kenneth Lay was ambitious. He believed the future of energy would be very different from the past. For decades, governments heavily controlled energy markets. Prices were regulated. Competition was limited. But during the 1980s and 1990s, those rules started changing. Energy markets were becoming more open. Lay saw an opportunity worth billions of dollars. While others saw pipelines, he saw the chance to build an entirely new kind of company. Then came the first major turning point. Lay met a consultant from McKinsey & Company named Jeffrey Skilling. Skilling wasn't just intelligent. He was known for seeing opportunities that other people missed. When he looked at the energy industry, he didn't see gas flowing through pipelines. He saw a giant marketplace where energy contracts could be bought and sold just like stocks on Wall Street. It was a radical idea, and it would completely change Enron's future. Skilling proposed something revolutionary. Instead of simply transporting energy, Enron could become a middleman between buyers and sellers. If companies wanted to lock in future energy prices, Enron could help arrange those deals. The company could profit from thousands of transactions without owning all the underlying assets. Investors loved the idea because it sounded innovative, scalable, and extremely profitable. Suddenly, Enron wasn't being compared to utility companies anymore. It was being compared to financial giants. The strategy worked. Throughout the 1990s, Enron grew rapidly. Revenue increased. The stock price climbed. Wall Street analysts praised management. Media outlets described the company as a symbol of modern capitalism. Fortune magazine repeatedly ranked Enron as America's most innovative company. Employees felt lucky to work there. Investors felt lucky to own the stock. The company seemed to be winning at everything it touched. But success created a dangerous new problem. Every quarter, investors expected bigger numbers. Every year, Wall Street expected faster growth. Missing expectations could cause the stock price to fall, and falling stock prices were something Enron's leadership desperately wanted to avoid. The company had become addicted to growth. Once that happens, pressure starts building behind the scenes, and pressure often leads to risky decisions. To keep impressing investors, Enron expanded far beyond natural gas. The company entered electricity trading. It invested in broadband networks. It launched international projects. It pursued opportunities across multiple industries. On the surface, this looked like the strategy of a visionary company. But many of these new ventures were far more complicated and far less profitable than they appeared. Some projects were already struggling, even while investors were being told a different story. This is where another important character enters the story. Andrew Fastow became Enron's chief financial officer. Unlike Kenneth Lay, he wasn't a charismatic public figure. Unlike Jeffrey Skilling, he wasn't famous for bold ideas. His strength was finance. He understood complicated transactions better than almost anyone. And as Enron's growth machine demanded bigger and bigger numbers, Fastow began creating financial structures that would eventually become the heart of the scandal. By the late 1990s, Enron looked unstoppable. The company's market value soared. The stock price climbed above $90 per share. Investors poured in money. Business magazines celebrated the executives as corporate geniuses. But hidden beneath the success was a growing problem. Some investments were losing money. Some projects were failing. Some profits existed mostly on paper. And instead of revealing those problems, Enron was about to start hiding them in ways that few people could understand. By the late 1990s, Enron faced a problem that many investors couldn't see. The company looked successful, but some projects were struggling behind the scenes. Normally, a company would report those losses and accept the consequences. Enron chose a different path. Instead of showing investors the full picture, executives started creating financial structures designed to make the company look healthier than it really was. And this is where the story becomes much darker. One tool that helped create this illusion was called mark-to-market accounting. The idea sounds harmless. If Enron signed a long-term contract expected to generate profit over many years, the company could estimate those future profits and record them immediately. On paper, earnings looked impressive, but there was a dangerous catch. If those profits never arrived, the numbers investors had celebrated were often based more on predictions than reality. At first, investors didn't question it. The stock price kept rising. Analysts kept praising management. Media outlets kept calling Enron a revolutionary company. Success created trust. Trust created confidence. And confidence allowed executives to push the system even further. But while Wall Street celebrated, Andrew Fastow was building something that would eventually become the heart of the scandal. Fastow created special entities that existed outside Enron's main financial statements. One of the most famous was called Chuco. To ordinary investors, Chuco sounded like just another business partnership. In reality, investigators later found that structures like Chuco helped keep large amounts of debt away from Enron's balance sheet. The debt never disappeared. It was simply moved somewhere investors couldn't easily see it. The numbers were shocking. When Enron was eventually forced to correct its accounting, hidden arrangements connected to Chuco and related entities revealed hundreds of millions of dollars in previously concealed debt and significant reductions in reported income. Investors who thought they understood Enron suddenly realized they had been looking at a distorted picture for years. Then came another structure called LJM. The name was created from the initials of Fastow's wife and children. That detail sounds innocent until you learn what happened next. Enron allowed its own chief financial officer to manage LJM while still serving as Enron's CFO. Imagine negotiating a deal while sitting on both sides sides of the table. The conflict of interest was enormous, yet the arrangement was approved and allowed to continue. Using partnerships like LJM, Enron moved troubled assets, hid losses, and created transactions that improved the appearance of its financial health. The company wasn't solving problems. It was relocating them. Every hidden loss made the next hidden loss easier. Every accounting trick created pressure for another trick. Over time, the system became so complicated that very few people fully understood how everything connected together. One of the most controversial examples involved entities known as the Raptors. These structures were designed to protect Enron from reporting declines in the value of certain investments. On paper, the strategy made financial results appear stronger, but there was a major flaw. Many of these protections depended on Enron's own stock price remaining high. If the stock fell, the entire system could begin collapsing, and that danger was getting closer every day. Inside the company, some employees were becoming uncomfortable. Transactions were increasingly difficult to explain. Financial statements became harder to understand. Even accounting professionals later argued that many schemes involved only a small group of insiders and existed in areas so complex that lower-level employees often couldn't see the full picture. Complexity itself had become a shield. Then came a woman named Sharon Watkins. She wasn't a celebrity executive. She wasn't appearing on magazine covers. She was simply an employee who noticed that something didn't make sense. As she reviewed certain transactions, she became increasingly worried that Enron's accounting practices could destroy the company. What she saw wasn't a small mistake. It looked like a disaster waiting to happen. In August 2001, Watkins sent a warning to Kenneth Lay. Her message was chilling. She warned that Enron could collapse in a wave of accounting scandals. Think about that for a moment. One of the company's own executives was effectively predicting the future, but by the time the warning arrived, the machine had already become too large, too complicated, and too dependent on appearances to stop easily. Around the same time, another event shocked Wall Street. Jeffrey Skilling suddenly resigned as CEO after only a few months in the position. Official explanations pointed to personal reasons, but investors immediately became suspicious. Why would the leader of America's most admired company walk away during its greatest period of apparent success? The question spread rapidly across financial markets, and once people started asking questions, the illusion began to crack. For years, Enron's reputation had protected it from scrutiny. Now the opposite was happening. Journalists were investigating. Analysts were demanding answers. Regulators were paying attention. Hidden debt, secret partnerships, and accounting questions were slowly moving into public view. The company that had spent years creating an image of perfection was about to face a reality it could no longer hide. And what happened next would destroy the entire empire. In October 2001, the first major crack became impossible to hide. Enron announced a quarterly loss of about $618 million and disclosed a huge reduction in shareholder equity connected to Andrew Fastow's partnerships. Investors were stunned. For years, they had been told that Enron was one of America's strongest companies. Suddenly, the numbers looked very different. And this was only the beginning. Then things got worse. On November 8, 2001, Enron restated several years of financial results, admitting that profits had been overstated and that key financial information had not been properly reported. Wall Street immediately understood the message. This wasn't a small accounting error. It was evidence that the company's financial picture had been far less reliable than investors believed. Trust disappeared almost overnight. Analysts who once praised Enron started asking hard questions. Banks became nervous. Business partners began pulling away. Investors rushed to sell shares before things became even worse. The same company that had been celebrated as a corporate genius was now fighting for survival. And once confidence disappears in financial markets, events can move incredibly fast. At its peak, Enron stock traded above $90 per share. Employees proudly held company shares in retirement accounts. Many believed the stock would keep rising forever, but during 2001, the price collapsed. By the end of November, shares had fallen to less than $1. Years of savings were wiped out in months. For many employees, it felt like watching their future disappear in real time. One reason the collapse became so painful was that many workers had enormous exposure to Enron stock. Reports later showed that thousands of employees depended heavily on company shares inside retirement plans. Some people who thought they were financially secure suddenly faced retirement with far less money than expected. For them, Enron wasn't just a business scandal. It was a personal tragedy. Then came what looked like a lifeline. Rival energy company Dynegy publicly offered to acquire Enron. For a brief moment, investors and employees felt hope. Maybe the company could still survive. Maybe jobs could be saved. Maybe retirement accounts could recover. But after reviewing Enron's condition more closely, Dynegy walked away. The rescue deal collapsed, and with it, so did Enron's final chance to avoid disaster. On December 2nd, 2001, Enron filed for Chapter 11 bankruptcy protection. At the time, it was the largest corporate bankruptcy in American history. A company with more than $63 billion in assets had collapsed. Thousands of jobs were affected. Billions of dollars in shareholder value vanished. One of the most admired companies in America had become one of its greatest failures. But the scandal wasn't finished. Investigators soon turned their attention to Arthur Andersen, one of the most respected accounting firms in the world. Andersen had audited Enron's books for years. Investors trusted its reputation. Regulators respected its work. Then investigators discovered that employees had destroyed documents related to Enron while investigations were beginning. The revelation triggered national outrage. The consequences were devastating. Arthur Andersen was eventually found guilty of illegally destroying documents relevant to the investigation, although that conviction was later overturned by the Supreme Court. By then, the damage was done. Clients had left. Trust had vanished. One of the world's largest accounting firms effectively collapsed. Enron had not only destroyed itself, it had helped bring down an entire auditing giant. As investigators examined millions of records, thousands of documents, and years of financial transactions, the picture became clearer. Hidden debt, misleading disclosures, conflicts of interest, complex partnerships. What initially looked like a business failure was increasingly appearing to be one of the largest corporate fraud cases in American history. And now the attention was shifting toward the people at the very top. Kenneth Lay, Jeffrey Skilling, Andrew Fastow. The empire was gone. The legal battle was about to begin. After Enron collapsed, investigators finally began uncovering the full scale of what had happened. One of the first major executives to cooperate was Andrew Fastow. The former chief financial officer pleaded guilty and admitted his role in schemes that hid debt, inflated earnings, and misled investors. In exchange for cooperating with prosecutors, he became a key witness against the people who once ran one of America's most admired companies. The man who helped build the system was now helping explain how it worked. The biggest trial focused on Kenneth Lay and Jeffrey Skilling. For years, they had been celebrated as business visionaries. Now they faced accusations that they had misled investors while presenting Enron as financially healthy. After months of testimony and evidence, a federal jury convicted both executives on fraud-related charges in 2006. The fall was extraordinary. Men once praised by Wall Street were now being remembered for one of the largest corporate scandals in American history. But the story took another unexpected turn. Before he could be sentenced, Kenneth Lay died in July 2006. Jeffrey Skilling was sentenced to prison and ultimately served more than a decade behind bars before his release. Meanwhile, thousands of former employees were still dealing with the consequences. Many had lost jobs, retirement savings, health benefits, and years of financial security. For them, the scandal wasn't just about executives or courtrooms. It changed their lives forever. The impact of Enron went far beyond one company. In response to the scandal and other major accounting failures, the United States passed the Sarbanes-Oxley Act in 2002. The law increased corporate reporting requirements, strengthened oversight of public companies, and attempted to make financial fraud more difficult to hide. Even today, decades later, public companies, auditors, executives, and investors still operate under rules shaped by Enron's collapse. More than 20 years later, Enron is still studied in universities, business schools, courtrooms, and boardrooms around the world. It remains one of the clearest examples of how intelligence, ambition, reputation, and success can create a dangerous illusion when accountability disappears. Enron did not collapse because it lacked smart people. It collapsed because too many people stopped asking difficult questions. And that leaves us with one final question. If a company praised by investors, auditors, analysts, regulators, and the media could hide the truth for so long, what warning signs might we be ignoring today?